So a quick hint about myself. My name is Mohanad Yakout, and I'm the Global Head of Market Research at ONEPRO. I'm a certified financial technician and a chartered market technician of level 2. And let's start by having the definition of market structure. It's the very basic form of understanding how markets move. We should ask a very important question. Does prices move, or do prices move in a random manner? Yes or no? A lot of people will say, yes, prices are random. We can never expect what will happen. And I'll tell you, yes, prices are random. However, in a specific structure. So they have some sort of behavior. This behavior is repeated again and again and again, but in a random manner. If you understand the structure and the form, you will somehow be able to predict what will happen next. And that's what we're going to do today. So it's the basic form of understanding how markets move. It's the framework or structure that defines the price movements of any asset. Let me tell you, what I'm going to explain to you today about the market structure is nothing new. It's not something that we have discovered lately. However, it has been there for a long time. And to be honest with you, it has been there since the beginning of technical analysis, specifically by Charles Dow. I guess most of you know about the Dow theory, where he said we have some trends in the market and the basics of Dow theory. So the market structure somehow is not new. However, the way that we will be looking today at Charles Dow theory will be a new perspective. It will give you a lot of insights about what's happening in the markets. The market structure can be broadly classified into three distinct categories. The bullish market structure, where prices are going up, the bearish market structure, and the sideways market structure. And yes, if you tell me that those are what we call as trends, they are the basic trends. However, today we'll not call them as an upward trend or a downward trend, but let's name them as a bullish market structure, a bearish market structure, and a sideways one. Before understanding the market structure, how do we even analyze the market structure? If you have any price chart, okay, if you are new to technical analysis, or if you have just opened the chart today for your first time, you don't have any lines, any supports or resistances, no any patterns on your chart, it's clear, naked chart. What do you do in order to analyze the market structure? Step number one is to identify the highs and the lows. We all know that prices never move in a straight line, right? They don't go up like this, and they never fall like that. Sometimes they do, but it's not the normal behavior. The normal behavior is that if prices are willing to go up, they go up a little bit before retracing down to continue the move higher before another retracement takes place, moves higher, so on and so forth. So those highs and lows that's being formed on your chart is the number one thing I want you to focus on, identifying the highs and lows. After that, you will be able to spot the market structure, and let's see how this will go. The bullish market structure, quickly, just a recap on the trend basics. How do you know there is a bullish market structure? When you identify the highs and lows, you will pretty much see that there is a high followed by a low, then an HH, which is a higher high, followed by an HL, which is a higher low, and so on. So this is an upward trend. It has two conditions to exist, higher highs and higher lows. I know those two conditions sound pretty much simple, but please remember them. Higher high and higher low is a bullish market structure. How about let's have a look on the bullish market structure. This is a pretty much simple upward trend. You can see it's the US dollar on the daily time frame, I believe. This is what you get when you open your chart. Naked chart, no indicators, no line charts or low lines on your chart, no resistances or supports, nothing. How do you analyze the market structure? By identifying the highs and lows. So quickly, follow me with the highs and lows. Prices started forming a high right now, or right here on beginning of September, followed by a retracement to form a low, a new HH, which is a higher high, a new HL higher low, prices continue to follow some higher highs and higher lows, forming a bullish market structure. And this is the bearish market structure, pretty much the opposite. What are the two conditions for a bearish market structure? A lower high and a lower low. So prices move down a little bit, they register a new low before retracing to the upside, forming a new high, and then continues to register lower lows and lower highs, known and marked on the chart. This is a bearish market structure, and I believe this is the euro versus the US dollar. What do? You identify the highs and lows. Prices started forming a high, then low, lower high, lower low, and prices continued the move downwards. What are the two conditions for a bearish market structure? A lower low and a lower high. Again, this is pretty much very simple, but very crucial for you to remember those. This is the sideways market structure. Prices are not going high, they are not going lower, they are moving in a sideways range. Each high is equal or at the same level as the previous high, and each low is at or equal to the level of the previous low. So we have equal highs and equal lows. Again, what are the two conditions for the sideways market? Equal highs and equal lows. This is a sideways market structure. How do you know that? Simply by identifying the highs and lows. So it was a high followed by a low, an equal high and an equal low. That's when you know that the market is doing nothing. It's just moving in a sideways range. How to use market structure in your trading? What I've explained up till now is the first part of my session, the pretty basic stuff. Let's add a couple of concepts to what we have very simply discussed and know how can we use those very simple information in our day trading. In order to understand how to use it in our day trading, we need to add two concepts. What is the break-off structure, or the BOS? That's the first thing that we need to know. We agreed that the market moves in some sort of structures, either bullish, bearish, or sideways. We also know that markets can never move in the same structure for a long period of time or forever. It has to change. So maybe today, if we're talking about the US dollar, it's in a bullish market structure. It will not continue that way. It has to break out of structure, which is the bullish one, and do something else. This something else could be a bearish market structure or a sideways one. So the BOS, or the break of structure, is basically when the markets get fed up or says it's enough of this current market structure and let's do something else. So from bullish to bearish, from sideways to bullish, from bearish to bullish or to sideways, and so on. This is the break of structure. It's basically when the market fails to continue trading in the previous structure and starts forming a new one. For example, if the market has been trending in a bullish structure and then prices decline to a limit, it's no longer bullish, we can say it's a break of structure. So let's say the dollar index right now is going higher, okay? It doesn't go high or it doesn't go to the upside in a straight line. It goes up a little bit before retracing. When the dollar index retraces a little bit right now, if you call me, I'll tell you, okay, buy more, because the prices have gone down a little bit, so it's a good opportunity to buy. But at some point, if the dollar index continues to move lower in the bullish structure, I might tell you, okay, don't buy more. The dollar index might be breaking out of structure. It's no longer bullish. We are going bearish on the dollar index. This is basically the break of structure. What is concept number 2? And this is the last thing I'll explain today. The remaining of the session will be practical examples. The trend reversal of point is the exact point or price level on the chart when penetrated, we can know that the break of structure happened. So again, on the same example on the dollar index, it's going down a little bit. I'll tell you, buy more, okay? It's going up. When it goes down a little bit, I still see that it's going up. I'll tell you, buy more. At a certain point, if you call me, I'll tell you, don't buy more on the dollar index. We are no longer going higher. We will continue the move lower. That exact point where I changed my point of view on the dollar index was basically the trend point of reversal, what we call as POR. So, simply put, the BOS happens at the POR. What does that mean? The break of structure happens at the point of reversal. That's the two new concepts that we have just explained today, and let's apply that on the charts. How do we know the trend point of reversal? Remember the two main conditions of the upward trend or the bullish market structure: higher highs and higher lows. If the market is moving higher, registering new higher highs and new higher lows, but prices started to move lower, it broke below the last low formed. This is the point of reversal. So in the bullish market structure, it's the last low. In the bearish market structure, it's the last high. And in a sideways market structure, it's either the high or the low. I know I might be losing some of you right now. Let's apply on the charts. This is the bullish market structure, right? It's a higher high, higher low, and its prices are going up. Every time we register a new higher low, the last low is always the POR, which is the point of reversal. As long as the trend or prices are moving above the last low in a bullish market structure, we are still in the market structure. If prices move down, this is a retracement. When prices move below the last low, which is the point of reversal, this is when I tell you, okay, we are no longer in a bullish market structure, we are changing the trend. That's what happens when the break of structure happens on the bullish market structure. So we were basically going higher. We started moving lower a little bit, and here, prices started to register an LL, which is a lower low. A lower low is not basically one of the two conditions for an upward trend or a bullish market structure. We said it's a higher high and a higher low. We never said a lower low should appear in a bullish market structure. That's when you know that we have broken below the last low, we have penetrated the point of reversal, we are changing the direction. This is the exact opposite for the bearish market structure. Two conditions, remember? Lower low and lower high. Prices are moving lower. The last high registered is always the point of reversal. So from here, prices can go a little bit to the upside, okay, for a retracement. Till here, it's fine. We are in a retracement. Once we break above the last high, that's what you get. You get a new higher high. A higher high should never take place in a bearish market structure. Remember the two conditions? Bearish market structure, it's a lower low and a lower high. A new higher high appearing here, this means a break of structure or a BOS, which happens at the point of reversal. And this is the sideways market structure, very simple. You have some equal highs at the resistance, and you have equal lows at the support. If prices break out either side, you either have a new higher high or a new lower low. It's not one of the two conditions for a sideways market. That's when you know that the sideways market is over. Time for some market examples. This is the chart of US oil, okay? No any lines, no any diagrams or charts, no any indicators, it's a naked chart. How to analyze the market structure? Remember, number one, identify highs and lows. That's what you get. And I'll show you quickly what's happening here. Prices started by forming a high, followed by a low because it was moving lower. Lower high, lower low, prices went down and continued moving in lower lows and lower highs. Till when? Prices here registered a lower high, a lower low. Till here, prices were basically in a bearish market structure, right? What happened here is that we had a new equal high. That's the beginning of a sideways range. After that, you can see what happened, an equal low, because it's already a sideways. Another equal high, another higher low, and the break of structure happened. This is exactly what I'm talking about. This rectangle, which is in red color, this is the bearish market structure. Okay, followed by the yellow one, which was the sideways market. Here, exactly, when it was basically trading in a sideways range, prices broke above the last high. We shouldn't have a new higher high in a sideways range. That's the exact break of structure that we are having. And you can see how by simply analyzing the highs and lows, you can see that the market was moving lower, a little bit to the sideways, break of structure, and we went higher. No any use of trend lines. I never use trend lines, by the way. I've maybe used it for 3 or 4 months at the beginning of my career. That was 6 years ago. And I came to a conclusion that trend lines are made to be falsely broken. You always get false breakouts out of the trend line. So I always analyze the trend with my eyes, with the highs and lows identification on the chart. Another example, and this will be a little bit harder. Why? Because it is on gold. Here on this chart, we have multiple BOSs, which is multiple breaks of structures. What do we do? As number one, we identify highs and lows. That's what you get. Here I didn't actually name them, which is lower and higher. However, let's have a look on it real quick. Prices were going lower. A series of lower lows and lower highs. This is a bearish market structure. Prices moved sideways here for a very short period of time. It registered 2 equal lows. It started forming a higher high, which shouldn't appear in a downward trend. So I really believe there was a break of structure here, okay? Prices continued the move to the upside. Higher highs and higher lows. And here we had another break of structure. If you want to see it more clearly, that's what you get. The red rectangle at the beginning of the chart is basically the bearish market structure. And here, where I exactly told you that there was a break of structure, why did the break of structure happen here? Because it was the first higher high to register. We never could have a higher high in a downward trend or a bearish market structure. And look from here, what happened to gold price after that? It went up. A new bullish market structure happened. When did this end? By forming the first lower low, which was basically by the break of the last low. So in a bullish market structure, higher highs and higher lows, we started seeing a lower low, which should never take place in a bullish market structure. That was when you go short, because you know markets are changing structure. That's pretty much very simple and very easy. Thank you very much. We can visit us at booth 110 to meet our team at ONEPRO. Thank you.